Attention all future homeowners. I'm going to be diving into the FHA loan. You've probably seen this acronym before. You might have even heard it a time or two, but what does it really mean? And how does it help you become a homeowner in the future? If this is the first time that we've met, my name is Seanu Uyehara. I'm a branch manager with Loan Depot, helping you finance your homes all across the country. Whether you're a first-time home buyer, you're buying your vacation home, or you're an investor looking to build your real estate portfolio. A lot of the information I share with you has been developed over my 15-year career, leading one of the top teams in the entire country. So make sure you hit the description below for links to more information on how to get your mortgage right. If you ever need a pre-approval completed or a second opinion on your refinance, make sure to send me an email. I'd be happy to do a no-cost obligation to make sure that you are getting the right mortgage. And if you find these videos helpful, share this with your friends and family so we can spread the love and make sure that you are doing the right thing with your home loan. Today, we're talking about FHA financing. And in my opinion, it is an amazing loan, especially for first-time home buyers. Now, it's not catered to first-time home buyers, but many first-time home buyers do utilize this program. Now, sometimes it does get a bad rap because of the down payment or maybe even the credit qualifications. But in my opinion, there are still lots of buyers out there just like you that will utilize this loan program to be successful to get you to cross over from being a renter to becoming a homeowner. Now, some general highlights as to what FHA looks like. FHA is a government insured program backed by the Federal Housing Administration, hence the acronym FHA. Now, why many first-time home buyers utilize this program is because FHA actually allows you to go down as low as a 520 credit score. So as far as its credit requirements, it's very lenient. Now, if your credit score is under a 580, so we're talking a 579 down to the 520 range, FHA requires you to put at least 10% down. I've yet to have anybody do this. I think we might have done one in the last several years. So it's very, very rare that we come across that situation, but the guidelines are there for you to take advantage of that. However, this is where the bulk of you lie. You have at least a 580 credit score or better, and your minimum down payment required is only 3.5% down. So that's why this is such a popular program, because of the low down payment and the lenient credit score requirement. One thing I will point out though, FHA should not be a loan that you get into and you stay in it forever. This isn't a set it and forget it type of loan. Think of it as a way for you to get your foot in the door, and then once you're a homeowner, hopefully you're building up your credit score, and that way you can refinance out of the FHA loan simply because of the mortgage insurance that's placed onto the mortgage. On an FHA loan, it is there for the life of the loan. So the only way to get rid of it is you have to refinance. So this isn't something that you're gonna get into and never touch your mortgage again. You'll probably get in if you have a lower score, hopefully build your score up in the next couple of years and get yourself in a better position to refinance. But nonetheless, it's a great program. So I'm gonna run through a lot of details of the loan. So make sure you're taking notes. And if you ever have questions, make sure to comment below. I'll be happy to answer them. Or as always, you can send me an email and I'll reply to you directly. So we're gonna start with some of the credit requirements and the benefits to FHA. Like I mentioned, FHA can go as low as a 520 credit score. So anything between that 520 to the 579 range would require a 10% down payment. For example, if you're looking to purchase a home here in Las Vegas and you were buying a $400,000 house, 10% down would mean you'd have to come in with at least $40,000. Now remember, your down payment and your closing costs are two separate things. So just the down payment alone, if your credit is in that range, again, from 520 to 579, you would need the 10% down, and in that case, it would be $40,000. Now, if your credit score is at a 580 or better, and we're gonna look at the same scenario at $400,000, you would only need to come in with 3.5%, which is $14,000. So significantly less, especially if you can get to that 580 range. This is where it becomes a good strategy. Let's say you're at a 550, 560, 570 credit score. Could you purchase? Absolutely. However, if you can get your credit score maybe up another 10, 20, 30 points, you can minimize your down payment pretty significantly. So this is why, even though the guidelines might say that yes, you can buy and that you might have the money to do it, but it may not make the most sense to do that. So that's why we always revert back to getting pre-approved. That way your lender can give you the best course of action and give you some options to consider. Because you can see, obviously, putting $40,000 down or $14,000 down, quite a big difference as far as the down payment goes. Now, another reason why FHA is commonly used is because sometimes there are situations where our clients have had some mishaps in the past. And I'm talking bankruptcies, foreclosures, collections. All of these things do weigh on your credit score. So whether it's dragging your score down or maybe you've recovered from it, but you still have that blemish on your credit report. I know sometimes I've spoken to clients where they want to wait until those blemishes are all completely taken off their report. This is costing you time and the ability to gain that appreciation in a home. So the cool thing with FHA, if you've had a Chapter 7 bankruptcy, the waiting period to be able to purchase is only 2 years after your discharge date. So again, just because you had a bankruptcy, that doesn't mean your chance of owning a home is completely lost. You just have to wait 2 years from that discharge date in order to purchase again. The main thing that you want to focus on after your discharge is to start reestablishing credit. I've had clients in the past that they completely swore off credit. They said, I'm just going to pay everything in cash, which is totally fine. But if buying a house is a goal of yours, you will have to reestablish your credit. Whether that's getting a secured credit card at first, just to build some credit history again, then you can work your way to traditional credit cards or car loans or anything else that could potentially help you build your score. Nothing's really off the table at that point. You want to look at anything and everything that can help rebuild your credit, because as a mortgage lender, that's really all we're concerned about. We're not really worried about you having the bankruptcy. We know that does happen and it's part of life sometimes for people, but we do understand that, hey, we're all human. And what did you do after the fact? So if you can demonstrate the ability to rebuild your credit and be on time with your payments, a lender is certainly willing to help you and get the financing in place. Now, if you've had a Chapter 13 bankruptcy, you have to be in the bankruptcy period for at least a year and you've made on-time payments. You also need to make sure that you have approval from the courts to be able to purchase a home. So with a Chapter 13, remember, same thing like a 7 in a way where you're not going late on your payments. You're continuously making payments back to the courts and everything is up to date with your bankruptcy. After 1 year, you can purchase. Now with a foreclosure, you only need to wait 3 years from that date in order to be able to use FHA financing to purchase another home. So again, we've seen tons of people lose their homes during the foreclosure crisis in 2008. Many of them, when they were ready to purchased using FHA financing. So this is why FHA is such a great program. Like I mentioned in the beginning of this video, it's very lenient as far as its credit guidelines go. So if you've had some of these instances that happened to you earlier in your life or in the last several years, don't give up on home ownership. There's always a path that we can get you back on in order to get you across the finish line again and become a homeowner. Another benefit to FHA financing is that if you have any medical collections, we essentially ignore them when we qualify you for your home loan. So this is really important because many times you are looking at your credit report, which you're doing a good job, and you are trying to get ahead of the game to make sure that when you talk to a lender that you have no issues qualifying for your mortgage. But this is where sometimes you start to pay off collections and pay down debt when you don't necessarily need to. Remember, when a lender looks at qualifying you for your home loan, all we are looking at is the minimum payments on your credit report. So it doesn't matter that you are being proactive and you're applying more money towards your credit cards or any other debt that shows up on your credit report. All we are going to look at is the minimum payment. That's it. This is where I remind you, don't just run off to go pay off your debt. Sometimes it's beneficial to talk to the lender first and get their guidance before you start spending that money, because once you spend the money and pay off the debt, it's not like we can go back and ask for the money back. So if you're tight on your funds to be able to purchase and close, you might want to preserve your capital first, get a good direction of what it's going to take to buy before you go and spend that money. Here is a slight downside to FHA. Because we're putting such a low down payment, there are two types of insurance that are placed on the loan which don't really benefit you. So the first one is your upfront mortgage insurance. You will see this terminology on your loan estimates. It's going to say UFMIP, upfront mortgage insurance premium. Now with FHA, the calculation that we use is 1.75% of the loan amount. So let's take our scenario again. Let's say we're borrowing $400,000. You're going to take that number, multiply that by 1.75%, which is going to give us $7,000. That $7,000 is then financed into your loan amount. So this is where, in case you ever foreclose on your home, there is an insurance policy against the property, so that way the lender and FHA can recoup some of their losses. Some people hate the fact that there is this upfront mortgage insurance premium. However, if you think about it in the grand scheme of things, you're financing $7,000 over 30 years. It really doesn't impact your payment so much. I personally wouldn't care so much because of the upside of owning a home, especially when you look at the last several years, how much equity homeowners have been building. I wouldn't let that small amount of money stand in the way of the huge upsides that you could potentially see by being a homeowner. Now, the other insurance on the loan is called your monthly mortgage insurance. This is also another factor that again gets placed on every mortgage with FHA. Doesn't really matter what your credit score or anything else is. The factor that the lender uses is 0.85%. This can be typically a little higher than a conventional loan, especially if you have really good credit. So again, another drawback, which sometimes people don't like this, but on the same $400,000 scenario, you would take that loan amount, multiply that by 0.85%, divide that by 12, which would give us a monthly mortgage insurance of about $283. So you can see you're gonna have to add that $283 into your monthly payment, which also includes your taxes, your insurance, and especially if you're buying here in Las Vegas, probably an HOA fee as well. You're gonna have to include as far as your monthly obligations. So the payment can start to creep up pretty quickly. But again, this is where you wanna look at your options, especially if you have good credit, you have some money to put down. Even if you're considering FHA financing, you want to look at the comparison between FHA and VA, so that way you can truly see on paper what makes the most sense, because mortgage insurance, it's a total waste. It goes back to the lender and it's not going to benefit you in any way as a homeowner. And if you've made it this far in this video, make sure to comment below FHA. I know you're still watching and I hope you're finding value. And again, if you have questions, make sure to drop those below. We're going to reply back and make sure you understand everything you need to know about FHA. Now, another thing that we're going to look at with FHA financing, this came about during COVID, where a lot of you were laid off of work. Some people were furloughed, and it affected your ability to then purchase. So how FHA looks at someone that was out of work for an extended period of time, the general rule of thumb is this: if you've been out of work for 6 months or less, there's really no waiting period in order for you to qualify and then go back to purchasing a home. However, if you were out of work for a period longer than 6 months, FHA typically likes to see you back to work for at least 6 months, and then you can try to qualify. Now again, there's other loan programs you can look at that have different requirements as far as the waiting period goes, but with FHA, that rule of thumb is kind of what every lender is going to follow. So just make sure you understand if you've been out of work or furloughed or anything else or impacted by COVID, how a lender will look at your employment situation when you do go back to work. And because we're in a shifting market right now, FHA is a great loan because you can get up to 6% in seller contributions to help offset your closing costs. This is a strategy that we've been using many times with our clients to help them win their offers. So whether you're using those funds to pay for general closing costs, or you're taking it a step further and using our strategy to buy down your interest rate, and you're letting the seller cover those costs for you. So there's a lot of flexibility with that 6%. Again, you want to make sure that you're working with a really good realtor, because they're going to do the best to negotiate and get you the most amount of closing costs. So that way, as a lender, we can help minimize those out-of-pocket expenses for you and even give you further strategies to look at to finance your home, so that way you are a winner at the end of the day. Now, another downside to FHA is that it has to be your primary residence. So this is where I've had conversations with a few clients that would ask, how would a lender know if it's my primary residence or not? So when we're doing your application, we will look at your employment situation. Let's say you're working currently in Texas and you want to buy here in Las Vegas. Well, the first thing we're going to do is ask you, well, is your job transferring you here to Las Vegas? Because again, FHA has to be your primary residence. There's no negotiating on that. If you can work remotely, that's fine. You can certainly use that type of financing. But there are instances where lenders have done occupancy checks. So if, let's say, you lied or didn't disclose accurate information as far as your occupancy, if the lender were to ever do an occupancy check and find out you weren't living in the home, they could essentially call the loan due, which you would have to pay whatever you owed in full. So you don't want to do that. Loan fraud is not a good thing to do. There's a lot of people that committed that during the '08 crash, and that's why a lot of things fell apart. In fact, there was an article I read the other day. Someone committed loan fraud, and I believe they got sentenced to 10 years in prison. So don't lie to your lender. It's not worth the headache. But some other great things that you can look at with FHA is you can house hack. I know this has become more and more popular these days with BiggerPockets and some of these investing websites or podcasts that are out there. So if you're a single guy or maybe a single gal and you buy a house and you've got some extra bedrooms, rent those out to your other friends or family. And that's another way that you can get your foot in the door with real estate investing. FHA allows you to do that as long as you're not buying the home and you never live in the property and you try to rent it out. That again is occupancy fraud, and you're defrauding the fact that you will live in the house when you really never plan on living there. FHA also allows you to buy multi-unit properties. So if you're buying a duplex, triplex, or fourplex, you can certainly do that. Again, as long as you're living in one of the units. That's another great way to become a real estate investor, where you have the other units rented out and you're building up some passive income. Or you're looking for ways to essentially pay the loan off faster, which I've also done an in-depth video on. So make sure to check out my playlist, because I do talk about some strategies about how to pay your home off faster. Now you might be wondering, well, what if I can't qualify for a higher priced loan because of the multi-unit situation? That does come up quite often. However, if the other units are rented, we can account for the rents that would be collected on those units to offset the mortgage payment. That's another great reason why many clients are looking to multi-units, because they know the cash flow will cover the mortgage payment and also help them offset the qualifications in order to qualify for such a higher loan amount. Another downside you need to be aware of is if you're looking to purchase a condo using FHA financing, you need to make sure that the condo complex is approved. You can go to FHA's website, which I'll drop that in the notes below, so that way you can check to see, is that specific complex that you're looking to buy approved by FHA? And not everyone is, so you need to make sure you do some due diligence. And that's again where a good realtor and a good lender will do that homework for you, so that way they can focus your searches on approved complexes only. Now there are times where you can get what's called a spot approval. So all the lender's doing is trying to make sure that they can get that one specific unit approved for financing. It's not always a guarantee. It is a crapshoot sometimes, and it doesn't always come through. But if a lender can get the spot approval completed, then you are lucky to get the financing there. But more importantly, I would make sure that you do check and have your realtor check to make sure that the units that you're looking at are FHA approved, because the last thing you'd want to do is fall in love with a condo that you can't get the financing on. Another issue that FHA poses is if you're looking to purchase a home that's flipped. So basically, it was bought and sold within a 90-day period. It doesn't even really need to be renovated. If it's transferring ownership within that 90-day window, you would not be able to use FHA financing. We don't really see this too often these days. If you go back several years when house flipping was running rampant here in Vegas and everyone was trying to flip homes, this came up and it was a problem because you couldn't use FHA financing on some of those homes. So those sellers would either wait to the 91st day, or you as a buyer, if you could not qualify for conventional financing, you would have to wait till you eclipse that 90-day window to then make an offer on the house. But in a hot market, most of those homes are not going to wait, and they're not going to sit for 90 days. So unfortunately, you would either need to switch and try to qualify for conventional financing, or you'd have to move on and try to find another property. FHA appraisals are a little stricter when they look at properties, because they are looking at the health and safety of the home in and of itself. Again, these loans are insured by the government, so they want to make sure that if you move into the home, there are going to be no issues as far as health and safety issues. You really want to make sure that the home is almost move-in ready. Now, one of the big things that always comes up here in Las Vegas is you need to make sure that there are earthquake straps on the water heater. That's something that a lot of agents miss. So you want to make sure that if you do buy a house and you are going through the process, before the appraiser gets out to the home, make sure those earthquake straps are there. If not, the appraiser will call it out because it's a violation of the code, and they will have to then send an appraiser back out to the home to re-inspect it, which you will have to pay for as the buyer, which will cost you another couple $100. So I would just get ahead of that, make sure the straps are there, get the seller to fix it, or have the agents negotiate that, so that way you don't have to pay for that as the buyer. Let's say you do find a house and it's not going to meet the requirements of an FHA appraisal. Instead of your realtor telling you you have to go with conventional financing or trying to make some last minute changes, you could also look at renovation financing. This is called an FHA 203K. This is a very underutilized program. However, it is very, very useful in these situations, because instead of you having to go and restructure your whole loan and try to qualify for a conventional loan, which you may not even qualify for conventional financing, your lender could look at qualifying you for an FHA 203K loan. So the cool thing about this program is that you can finance the cost of your renovations up front into your mortgage. So you could go into this house, it could be missing a stove, the floors could be completely tore up, you need to put new cabinets, countertops in there, maybe you even need a new AC unit. You can use the 203K loan to finance all of those costs into your mortgage. That way, when you move into the property, it's essentially going to be done to the way you want it. So don't get discouraged if you can't find a house. Maybe you love the bones of the property, but you just hate maybe the layout of the house, or maybe it just needs to be updated, which I tend to find that it's the case here in Vegas. So this is a great way that you can finance everything up front without worrying about going to get a credit card after the fact at Lowe's or Home Depot and trying to finance everything on a credit card after your purchase. Another big thing to consider when you are looking at FHA financing anywhere in the country is that FHA only goes up to a certain loan limit, and it's determined by the county that you're looking to purchase in. Again, I'm going to drop the link below so you can do some research for yourself, but this is also something every real estate agent and every lender should be knowledgeable about. So I wouldn't worry about this too much, but you do need to be aware that if you're looking to buy in a certain community or a certain price range, you may not be able to use FHA financing. Just to give you an example, here in Clark County, if you're purchasing a single unit, single family home, the loan limit for FHA is $420,680. Now, if you're looking to buy, let's say in Reno, a single family 1-unit home with FHA, the loan limit in Reno is $534,750. So you could see, you could easily mistake the two or not know the difference, and you might not even be able to qualify, especially if you can't go the conventional route. So make sure you have these conversations, or your lender is advising you of this information up front during your pre-approval. And that's also important if you're thinking about relocating to other parts of the country. Just because you qualified for a loan, let's say here in Vegas, and now you're moving to Ohio or Kentucky for whatever reason, you need to make sure that your pre-approval is updated. And if you can only qualify for FHA financing, that you are within their county limits wherever you decide to move. Now, when you are thinking about moving, many times you may want to use FHA financing again, which is totally fine. Just keep in mind, if you are in the same city, you will not be able to use another FHA loan. You can't have 2 FHA loans at one time. If you're moving to another part of the country, you may be able to pull it off. But if you're staying in the same city and you're trying to buy a house 1 year, live in it, move out, turn it into a rental, and keep repeating that process, you would have to use conventional financing. So just be a little careful with that, because I know a lot of times on social media, they're talking about ways and all these hacks of things that you can do to keep buying rental properties with very little money out of pocket. Doing something like that, you're going to run into a roadblock. So be prepared to have some money to put down to qualify the proper way. Now, in the environment that we're in right now, where interest rates have jumped up significantly over the last several months, FHA has a program where once rates come back down, you can refinance into a streamlined refinance. So it's a streamlined way, that's why they call it a streamlined refinance, to where you can lower your interest rate on your mortgage without a ton of paperwork. So FHA is going to look at the net tangible benefit that, hey, this homeowner wants to lower their interest rate. Do they meet the requirements to do so? And if they do, you don't need an appraisal, and you can literally get these done in a matter of weeks. So that's a really cool benefit to having an FHA loan. But remember, the goal with FHA is to essentially get you out of the FHA loan because you don't want to keep paying on the mortgage insurance. So the minute you have the credit score high enough, the minute you have enough equity in your property, you want to look at strategies to get out of it and get yourself into a conventional mortgage. Because again, that $400,000 loan that we talked about, that monthly mortgage insurance payment was close to $300 a month. So think about that. Every year, you are literally throwing away $3,600 that goes to nothing. If you can remove that, you can start paying down your house faster, or maybe saving up some extra cash, or investing that money into another fund or another investment vehicle. So this is where you want to be smart about these decisions, and you're not just throwing your hard-earned money away. I just gave you a ton of information on FHA loans, the good, the bad, even some amazing things about the program. I personally love FHA. It's a great way just to get your foot in the door. There's some people out there that talk bad about the loan. I would disagree with them. It's a good vehicle to get your foot in the door. Now, whether you're thinking about FHA, VA, or conventional financing, remember, we've got you covered all across the country. My name is Seanu Uyehara. Thanks so much for watching, and I will see you on the next video.